the General Practice podcast from Ockham Healthcare, supporting innovation in general practice.
This episode is brought to you in partnership with Practice Index. We explore what this year's budget means for practices and partners and how to prepare for the changes ahead. If you're looking to strengthen your finances, visit the Practice Index Hub and take a look at the finance package. Alongside helping to review your PPA income and manage stock effectively, you can now also quickly and easily calculate the impact of the changes using the free salary calculator. See how your practice could benefit from the finance package in the Hub. Book a demo at practiceindex.co.uk. Well, it was the budget yesterday, so I am delighted that I'm joined by three real experts in the field. So we've got Claire from Practice Index, Paul Gordon from Atomos, and James Gransbury from Assets. It's really timely that you're here. The budget was yesterday. And Claire, I know you've been working hard at Practice Index to get practices so they can work out the implications for them straight away.
Indeed, we have. It's one I watch with interest each year, the budget. I sit there poised, scribbling away. What we've done is make sure that our salary calculator is up to date. So for those of you who will potentially have been listening for a while or will have been using Practice Index for a while, you will know that when we had the big changes in national insurance thresholds, we were really quick off the mark to get a salary calculator up, which allowed practices to calculate quickly what the impact for them would be, because they were able to put in staff salaries, the rates, and then able to calculate the impact, because the impact was very different if you had very part-time, close to minimum wage staff than it would have been for perhaps your GPs who were already outside of that kind of NI bubble. So what we did in that sense was kind of have a look at that. And this year we've updated it. So it's by the point where people are listening, it will be live. So they can update their figures for this year. So it'll prompt you for those staff who are under the new national minimum wage, which is sitting at £12.71. So 50 pence increase over last year. And that then helps you to populate the calculator. You can run all sorts of scenarios. So you're able to sort of say, okay, if this staff group gets this, if I uplift these by this, then I'm going to have to uplift this group by that. It's really quick and really easy to use, very, very straightforward, and gives a really good, you can save a number of different scenarios so you can see really easily the impact of different changes you might make across your practice.
And for practices feeling the pinch, Claire, you've got the benchmarking tool for making sure practices are getting the most out of the NHS income that they can.
Indeed, we have. So we do lots of things around finance. You might guess that finance and practice finance is my happy home. So we've got Benchmarking Manager, which essentially looks at their practice income, NHS income, to clarify that. And it allows you to benchmark against other practices. Benchmarking, I'm sure James will agree with me, is actually really, really important. Comparison is the thief of joy to some extent. And I'll say that time and time again, but actually being able to benchmark, how are we doing? Does that match with what I know about my practice and what I expect to see from my demographic? You know, if I've got a very young practice, I might expect my flu income, for example, or my QOF income to be lower comparatively than other, more elderly or practices with more chronic disease. But actually being able to see the implications of that allows you to sort of unpick, is this doing what I would expect it to? And if not, what do I need to do about that? So Benchmarking Manager, incredibly helpful. And it's presented in a really easy to use graphical format. So you can see the trend over time, which I think helps rather than just looking at a big bank of numbers.
So I think this budget was maybe one of the most hyped budgets that we've had in recent times. I'm really interested to get your kind of reaction to actually when you heard it, or maybe you got access to it beforehand, like some individuals. What was your reaction to the budget then?
The reaction was quite pleasant. The build-up was a disaster. We took calls from plenty of medics prior to the budget. The two youngest phone calls that I took were two 50-year-olds, both of whom were looking to draw their NHS pensions. And they were terrified that they were going to lose some or all of their lump sum on a tax-free basis. And when I explained the age of 50, they would lose nigh on 40% of their ongoing pension forever, they chose not to draw their benefits, thankfully. But that was the type of call we were taking from most doctors on a rolling basis. It was a staggering period. The announcements, I think back on November the 4th from the Chancellor, about not really much being announced, if anything, ramped up the hysteria that there were rumours circulating around pensions, around inheritance tax, all sorts of changes. And I know James is going to cover off the partnership and how that was potentially going to be impacted. So many changes ahead, not many actually came to fruition.
Yeah, I was going to say, there wasn't many weeks that went by when I didn't have a phone call from somebody asking about what the future. When I have to pay this tax next year, I was like, oh, hold on a minute, where have you read that? Oh, I saw it in the newspaper at the weekend. The biggest ones were the partnership taxation potential. remember this happening. The news was talking about tax for partnerships because they don't pay the employer's national insurance to get their money out of the partnership. So they were talking about taxing, and the headlines were doctors, accountants and lawyers facing partnership tax. Then the next day they seemed to imply this was only for limited liability partnerships, LLPs, which GPs aren't permitted to be. So then they escaped it through that route. And then we had the budget yesterday, it wasn't in there at all. So all of this nervousness and things. And the other biggest one, which wouldn't have been on many people's radars, but certainly was on mine, was around the VAT thresholds. There was some noise about VAT thresholds being cut from 90,000. I'd heard it down to 50 and 30. Never happened, didn't come into play yesterday. But many of our GP practice clients sit between those kind of numbers. So they would have had to register for VAT for their private medical reports and other things like that. So as much of a budget of what wasn't in there as what was.
So what did you think, Claire? Was it a damp squib then, or was it like a relief?
It's a bit of a mixed bag, I would say. I think it was talked up so much in advance and so many policy ideas were floated that then I think the challenge, and it's not just a challenge of when we're talking about it, but also a challenge for policy, is that things that we do have unintended side effect consequences. So one of the ones that I know Paul and James will be, well aware of is that whole withdrawal of your personal allowance over 100,000. It forces people into situations where they do things artificially, and above and beyond 100,000, the impact is significant, not just because of the rate of withdrawal of your personal allowance, but then there are other impacts in terms of childcare credits that you can't get access to if you earn over £100,000. So potentially for people in particular who have got younger families, it's a real disincentive to work more if you're at a certain level in your career. And I think that's almost the opposite. And Paul's just said exactly the same thing in terms of the NHS pension, that the worry that these things might happen almost forces people into really artificial positions that they wouldn't necessarily normally take because they're worried about the consequences for them and their personal finances for their families. And that's a really big thing. £100,000 at the point where that was introduced was significantly more in terms of our standard of living than it is now because it's been around quite a while. So I think it's those kinds of things that we run the real risk when we're talking about it, that people take action. And obviously, once you've taken that 25% out of your pension, well, you've taken it. There's no scope. And if your pension grows beyond that, you haven't then got the scope to do more. So I think it's really difficult and really challenging to get the balance between what does public opinion say, but we can't, have ultimately policy by public opinion, really. The situation is the situation. And I think some of the speculation can be quite damaging, and it does make people do things that perhaps aren't necessarily the smartest thing for them longer term.
Following on from that then, what do you think, Paul, in terms of given what is in the budget, what should people be doing differently now that maybe they weren't doing before, if anything?
That really is the key question. There were lots of smaller, less painful announcements this year than were rumoured. So one thing from a planning perspective, very likely that the expectation moving forwards with clients is that we will just look at their entire current plan, but also what they'd like to be doing, be it workload-wise, be it retirement and slowing down, be it helping children and so on. Just trying to map out the next phase of their lives financially. Because if you look at the inheritance tax position, well, actually, we were quite worried about gifts being reduced, or if you made a gift, an extended period being required before that fell outside of your estate. At the moment, it's 7 years for a potentially exempt transfer. Suggestions were that that could increase to 10. It didn't. But the suggestion prior to the budget of it being 10 years may mean it's still in the crosshairs. Not necessarily rushing, as Claire mentioned, to make a decision, but if gifts are going to be given to family to help with deposits and so on, well, actually, they were untouched. They can still be made. Gifts from income were not adjusted. Mapping out the next phase of life and understanding how that impacts financially going to be crucial moving forwards.
And I know you always like to say this when you come on, Paul, but it's worth saying again that the NHS pension is a very good pension, isn't it? And so people who might be upset by it, I know there are no changes, but some of the costs associated with it, relatively speaking, it's still something people should stay in if they can.
The really good news is salary sacrifices will be adjusted in just over 3 years' time. That isn't relevant to those people paying into the NHS pension. So from that perspective, no change. As a result, the NHS pension, the new 2015 scheme that people are paying into, remains the same. They'll accumulate benefits at 1/54th of their pensionable earnings. Great news. The annual allowance still exists. So for some, they will grow their pensions by too much. Please be aware of that. Continue to check records. Continue to request information from NHS Business Services authorities. But also just check where you are. Make sure that if you can access My NHS Pension, and I don't literally mean mine, but your system, if you can log in and check where you are, you'll see the latest sets of benefits. Everyone's estimates now, up until next month, so December 25, should have updates factoring in the age discrimination case, if it applied to them. So there could well be two sets of benefits on every statement. It's good news if that's occurred, because you can see where you're going to be. Come the age of 60 or 65 or linked to state retirement age, depending on which version of the scheme you have membership within, that's when you can access those benefits without reduction. So knowing where you are is going to be the first step to working out how things look when you slow down or stop working.
Perfect. Thanks, Paul. In terms of the things that will impact practice, so the things that will be different, what were the things that you picked out, James?
One of the biggest revenue raisers for the government this time was the freezing of the tax threshold. So whilst you won't necessarily feel it, it just means that as things progress through time, you'll end up paying more tax in real terms at the higher rates. In fact, that's going to get around 8 billion of the total in 2030 and 12.4 billion pounds of the total extra tax in 2031. So that's one that you won't really see on the surface, but it's there underneath.
So that just means if you get a pay rise, or if your agenda for change goes up and your salary is uplifted, or you get an inflationary increase, you'll end up paying more tax on it because there won't be a corresponding change in the rate.
That's right. They call it fiscal drag. So you're dragged into these higher bands by the virtue of income going up. I know GP profits aren't always up as much as people would like, but they do trend upwards over time. We know that from our benchmarking. And so more people will be caught by the higher rates. Or if they're just below that horrible 60% effective tax rate between 100 and 125, they could be caught into that with the fiscal drag. So that's going to be frozen until 2031. So whilst it's not on the immediate radar, give it another 6 years, you'd expect people to be going upwards in terms of their net profits that they're earning from their practice. So that's one. If you've got other income outside of the practice, such as buy-to-let rentals and savings income, or even interest that you're receiving within the practice, which then gets allocated to you and money held on account, that's going to cost an extra 2% tax throughout the scale. Anybody that gets dividend income, this could be from private limited companies that people have. Some GPs have those, but also GP practices might have shares in their federation or other organisations which are limited companies and get dividend paid to them. There's an extra 2% to pay on those dividends above the £500 nil rate band for that, but only for basic and higher rate payers. So anybody earning over 125,000 as an additional rate payer doesn't pay that extra 2%. Other things, such as we've already discussed, one of the biggest things for GP practices will be the national living wage increase, 50 pence from £12.21 to £12.71, which is 4.1%. So just something to look out for next year when the DDRB recommends their pay uplifts. Just remembering that those at that scale would have already maybe had 4.1% if they're on the minimum wage. And then personally, for the GP partners and practice manager partners, or any partners really, you got an extra 3 pence per mile. If you've got an electric car, 1.5 pence a mile if it's a hybrid. That's coming in a couple of years' time, 2028.
When you say an extra 3 pence a mile, what do you mean?
So if you're driving 10,000 miles a year, you're going to have to pay an extra £300 alongside your duty, your vehicle excise duty each year. They're calling it an EVED. So electric vehicle excise duty on top of your normal, what we used to call road tax. I've got an electric car, have had for 5 years. Last year I wasn't paying anything to run it on the roads. Next year it's going to be about, 2028 onwards, it'll be about £800 with the amount of miles that I do and the fact that I'm paying road tax now. And if you count how many electric cars drive past, there's quite a few of those, so that's quite a big revenue raiser. Electric cars have been giving GP partners or any partners good tax relief in the last few years, so it's been quite a popular option for people to be buying electric cars. And now they're kind of getting caught up in terms of how much tax they're going to pay.
What do you think, Claire? Do you think that increase in the national living wage is the real stinger for practices?
I do, partly, and James has just sort of referred to the DDRB there, that actually when we're talking DDRB, the government will always say, well, we fund it. But part of the challenge for us, and obviously Carr-Hill is under consultation because it's at best a very inexact science, but the mechanism by which we adjust for salaries means that less than 50% of the practice's baseline payment is actually uplifted by that. It's about 44% of that baseline figure is uplifted by the percentage that is given in DDRB. Great, except for the fact that most practices, I think, would say that their staff wage bill is significantly in excess of that 44%. So every time that this happens, we end up with the practice having to pull back the deficit at 4.1% for your lower paid staff. And I don't think any practices would say that they don't feel that their staff deserve more. I think in general, practices really want to make sure that their staff are paid and paid well for the job that they do, because they are hugely appreciated and they do a difficult job. But I think there is a massively important piece in terms of making sure that the partners are compensated for the fact that they bear a lot of risk in comparison to perhaps other parts of the NHS, because they personally put their livelihoods, their houses ultimately at risk. And I think it's one of those things that actually it provides a massive challenge to find that balancing act between what's reasonable and what's fair to your staff, and then the payments that are coming in that actually don't match what the government says they're funding. And I think it's been an ongoing challenge year on year on year, that actually we get staff are given a percentage that actually isn't reflected appropriately in the NHS budget that we're given. And I think that's a real and present danger for practices, really.
And I guess that could be even worse this year, because with this review of the Carr-Hill formula, you could well end up in a situation where half the practices end up getting less money and half practices getting more money. So if you're one of the practices getting less money, you potentially are going to be funded even less than normal for this. What's your take, James, on this review of the Carr-Hill formula, and how do you see that playing out?
It'd be an interesting one to watch, especially as the government aren't talking to the BMA anymore as part of the contract negotiations, because I think they would have been feeding in very heavily into the Carr-Hill formula. We know it's been not working correctly since it was introduced, but whatever you do to replace it has probably got its flaws as well. So as Claire was saying, you've got winners and losers. I wouldn't want to be the one that decides how to refine the Carr-Hill formula, but it definitely needs some sort of revision.
But is your sense there'd be some sort of, like we've had minimum practice income guarantees in the past where there's been a change? Do you think there would be something like that? Or because we're hearing rumours that it has to be cost neutral, which I assume that means money gets taken off practices that have received too much to the ones who haven't received enough.
Well, MPIG was always a sticking plaster, and then they pulled the sticking plaster away and left people with the wound underneath it. So you need something where there isn't a sticking plaster and it's permanent, but that means extra money. You can't square everybody up so that they're all benefiting without putting extra money in the system, but that doesn't appear to be the case in the budget. The only things where the NHS was mentioned was the health centres, hoping to get 100 or 125 of those built in the next few years. There was also NHS investing in technology to improve productivity, 355 million in the 27-28 year. So this isn't always the place where NHS budgets get sorted out, in this budget, but it was woefully short on extra money going to the NHS. I certainly wasn't one of the headlines that I saw this morning. If there's no extra money, it's hard to fix something that's broken without having losers as well as winners.
Is that your take, Claire, on the review of the Carr-Hill formula as well?
Yes. So I was speaking not that long ago at one of the conferences, and one of the points I made was, if you are currently doing well in terms of your weighted list, you need to be carefully considering what that might look like for you if you are a loser under this, because the cost neutral aspect of it's a complex picture, Carr-Hill. It isn't perfect by any stretch. But what they're talking about more broadly is emphasis on deprivation. So some of the populations or the practices who've done well out of their Carr-Hill population are necessarily going to find that they are not going to benefit as much under a system that favours deprivation. So one of the big takeaways from me was, if that becomes a risk for you, you need to consider, what does that look like for us? How would we cope and how would we manage with that if the total amount of money being paid over is not actually going to be more, but you are going to lose a chunk of yours? How are you going to manage that? What does that look like for you? What changes can you make to make sure that you stay sustainable in the longer term?
Do we have an actual time frame for when it would be implemented, or is that something that would come out of the review, do you think?
The honest answer to that is, I think it's like any consultation. It grows arms and legs, and I say that all the time, but I think part of the difficulty, and James has referred to that, is that if we've got a situation where there is a level of distrust between the negotiating parties, then that is automatically going to provide for more difficulty. We've had an imposed contract over many years. now. It feels like, this year obviously wasn't an imposed contract, and look how that's gone. So I think there's a real challenge that ultimately general practice in the majority is partner owned, and partners have to have that seat at the table, really, not just GP partners, obviously, who are well represented in that sense by the BMA, but, practice manager partners, IGPM, looking really, they've got significant amounts of experience. And if we're looking at that journey towards integrated neighbourhood teams and how that might look in primary care, then actually involving people who are looking at that on the ground, have experience outside of the medical, is actually really, really important.
Maybe we need to save that topic for another podcast. In terms of the budget then, what else, Paul? I know you're worried about your milkshakes.
I'm terrified about the milkshakes. Thank you for that, Ben. Sadly, if you're a milkshake fan or indeed a prepared latte fan, so let me just clarify, anything that is already made when you purchase it, rather than something you buy in a cafe or coffee shop that is being made for you, is going up. There is going to be effectively the sugar tax added to it from April of next year, largely down to the fact, I wasn't aware of this, but an average latte that is purchased off the shelf has up to 8 teaspoons of sugar within it. So I do understand the logic there. But there's some other taxes that are either rising, and alcohol and tobacco, the usual, but also gambling. Online gambling is increasing quite significantly, up to 40% now. But ironically, in-person gambling is not. And then perhaps my favourite from yesterday is that bingo duty is being abolished from April of next year. So there is some good news if you like bingo at least.
And there have been changes to ISAs that I don't think we've covered. If we've got ISAs, should we be doing anything different with them?
That's a very good point. Quite significant changes proposed, actually. So from April 2027, the allowance is going to remain at £20,000 per year per person. However, if you're under 65, only 12,000 of that 20,000 can be invested within cash. The other 8,000 will be invested in the markets. So we'll move potentially up and down as the markets move. The reasoning behind that is quite straightforward. Chancellor is hoping to encourage investment. Now, whether or not there's any bias towards UK investments, nothing stated at present, but the ambition is that that will be invested rather than simply within cash. And one of the quotes from yesterday was that £1,000 invested year after year within stocks and shares would have been significantly higher valued than had it remained within cash. And that's largely down to inflation. So the markets will naturally have blips. There will be ups and downs within the stock market. We saw that back in April with the tariff comments from across in the US. But in reality, the markets have bounced quite significantly since. We don't know when the next dip may be, or indeed the next significant rise. But over time, the markets have typically performed very well, especially against cash, and ideally and crucially against inflation, normally above that. If you're over 65, the allowance will remain at 20,000, and it can all remain within cash if you choose. Those that have existing ISAs, we expect no change. It'll all be prospective and in the future. So April 27 onwards, these changes will occur. Those that have existing ISAs, just continue to check what you have, where it's invested and how it's doing, and make sure it aligns with what you would like it to be doing in terms of your risk profile, be it very cautious and cash, or very adventurous and in the markets, or at the top end of the markets. Make sure it suits what you're looking to achieve. And one last thing on ISAs, lifetime ISAs are being consulted on in early 2026. Now, effectively, they were set up for under 40-year-olds to either save towards retirement and accessed in their 60s, or indeed save towards their first-time purchase of a property up to a value of $450,000. Now, what has happened is house prices have increased, so not all of those purchases now fit within $450,000, so some are paying penalties. Great idea initially, where someone would pay in up to £4,000 and be awarded a 25% bonus in addition to that. Every year they made those contributions. It's being consulted on. We expect some changes. It may be simpler, and one would hope with lower penalties for accessing that money sooner.
Well, what do we make of it then? What's your kind of summary, James? And so you're at practice listening to this, you're thinking, what do I make of this budget and what does it mean? What's your kind of overall summary of the budget?
So roller coaster of a build up, lots of threats and things which could have come in, which didn't. a few things that are hidden, like the freezing of tax thresholds for the next, up until 2031. That's a long time to have frozen tax thresholds, and the minimum wage going up 4.1%. So I think there's a delayed tax take here. The next couple of years, we probably won't see too much in the way of differences. Anybody that's thinking about incorporation and forming a limited company might reflect on that decision if they haven't already, because the dividend tax rate going up another couple of percent might make the difference between not wanting to versus wanting to. So if all of the things that have been predicted came true, it would have been a very disastrous budget. But as it stands, I think we just have to wait until the next budget to see what that one brings.
Is that what you'd say, Claire? Like, not great, but could have been worse?
Yes, I think James has nailed it there, really. It was a budget of much tinkering around the edges, really, rather than any really massively significant things, obviously, other than minimum wage, which will affect a lot of people. I think there are changes, but broadly speaking, it's not had the impact that perhaps it might have done in a negative way. So that's probably a good thing, really.
And finally, from you, Paul?
I think I'd prefer calm before the budget next year. In terms of financial planning, the outcome considerably better than we feared across the board, across the entire spectrum, from investment, inheritance tax, and indeed pensions, particularly for the NHS, because they were left untouched this time round.
Perfect. Well, really helpful. Thanks for making the time to share in such a timely way after yesterday's budget. Really appreciate it. In this episode, we covered the major budget announcements and what they mean for general practice. We looked at how Benchmarking Manager in the Hub tracks your performance against practices in your PCN and your local area to help you review and improve your financial position. Quickly and easily work out the impacts of the budget for your own practice for free by using the salary calculator in the Practice Index Hub. Simply log in and head to the Finance section on the left-hand side. To see the whole finance package in action, book a demo at practiceindex.co.uk.
The General Practice Podcast from Ockham Healthcare, supporting innovation in general practice.